Let's talk about the economy. Economic indicators are like the economy's report card. They tell us if things are booming or busting, impacting everything. Think of them as weather forecasts for your money. They signal whether to spend, save, or invest. Understanding these indicators helps you make informed financial decisions. It's about having a clue, not being clueless. Inflation is a silent force that gradually erodes the value of your money over time. Imagine going to the store and realizing that the same amount of cash buys you less than it did last year. That's inflation at work, making each dollar stretch a little less. It's not just about higher prices, it's about your purchasing power shrinking, affecting everything from groceries to gas. As prices rise across the board, your paycheck doesn't go as far. Everyday essentials like food, fuel, and housing become more expensive, and families have to make tough choices about what to buy and what to skip. Inflation can feel like an invisible tax, quietly taking a bigger bite out of your budget. The unemployment rate, on the other hand, tells us how many people are actively looking for work but can't find a job. It's a key measure of economic health, reflecting the struggles and successes of workers everywhere. When unemployment is low, more people have jobs, businesses thrive, and the economy grows. But when it's high, it signals trouble. Businesses may be closing, and families can face real hardship. Interest rates are a powerful tool used by central banks to influence the economy. By raising or lowering these rates, they can encourage people to spend and invest or slow things down to keep inflation in check. When interest rates are low, borrowing money becomes cheaper, so people are more likely to take out loans for homes, cars, or businesses. But when rates rise, borrowing gets expensive and spending slows down. These three indicators, inflation, unemployment, and interest rates, are deeply connected. Changes in one can ripple through the others, shaping the financial lives of everyone, from families to businesses. For example, when inflation rises too quickly, central banks may hike interest rates to slow it down. But higher rates can also make it harder for businesses to grow, sometimes leading to more unemployment. This delicate balancing act doesn't just affect traditional markets. The crypto market, including assets like Bitcoin, is also influenced by these economic forces. Even Bitcoin, often seen as independent from the traditional system, can rise or fall in response to changes in inflation, unemployment, and interest rates. By understanding how these forces interact, you can make smarter decisions and better navigate the complex world of finance. Everything is connected, and being informed is your best tool. How does economic data affect crypto prices? To answer that, let's start with one of the most talked about topics, inflation. Inflation is when the prices of goods and services rise, reducing the purchasing power of money. This can make people nervous about holding cash, so they look for assets that might hold their value better. Bitcoin is often called digital gold because, like gold, it's seen as a hedge against inflation. When people worry about their money losing value, they sometimes turn to Bitcoin, hoping it will protect their wealth. But the story doesn't end there. Bitcoin's reputation as a safe haven is still debated, and its price can be volatile, especially when big economic news hits. When central banks raise interest rates to fight inflation, traditional savings accounts and government bonds start to look more appealing. These options are considered safer, so some investors move their money out of riskier assets like crypto. As a result, we often see investors pulling money from crypto and putting it into these safer investments, especially during uncertain times. For example, in 2020 and 2021, interest rates were at historic lows, and governments sent out stimulus checks. This extra cash and cheap borrowing helped fuel a massive surge in crypto prices as people looked for new places to invest. But in 2022, the situation flipped. Central banks hiked rates to control inflation, and both the stock and crypto markets took a hit. Investors became more cautious, and many pulled back from riskier assets. Unemployment is another key factor. When more people have jobs, they feel confident and are more likely to spend or invest, including in crypto. Low unemployment usually means more money flowing into the markets. But when unemployment is high, people tighten their budgets,
With less disposable income, there's less money available for investments like Bitcoin or other cryptocurrencies. All these economic conditions, interest rates, inflation, unemployment, work together to influence how people view and invest in crypto. The relationship is complex and always evolving. It's a delicate dance between the old world of traditional finance and the new world of digital assets. Each move in the economy can send ripples through the crypto market. By understanding these dynamics, investors can make more informed decisions and better navigate the ups and downs of the crypto world. The economy's impact on crypto is real, and staying informed is key to making smart moves in this ever-changing landscape.
Crypto was once separate from the stock market. It was a non-correlated asset, unaffected by Wall Street. But as big investors entered, the lines blurred. Now, crypto often moves with the stock market. Economic news affects both markets similarly. Yet, crypto still has its own unique influences. It's a follower, but a rebellious one. Why do investors watch economic signals before diving into crypto? It's about risk management, avoiding bad timing. Economic trends are like tides. They influence market conditions. Low rates and growth create a risk-on environment. High rates and recession fears create a risk-off environment. Understanding these helps make strategic decisions. It's about adding logic to a volatile market. Ignoring the macro picture is risky. Before you dive into the world of crypto charts and data, let's pause for a moment and talk about some essential tips that every aspiring crypto whisperer should keep in mind. The crypto market is fast, unpredictable, and full of surprises, so preparation is key. Always pay close attention to major economic announcements, things like inflation data, interest rate decisions, and central bank meetings. These events can send shockwaves through the markets, sometimes in ways you might not expect. Don't rely on just one chart or indicator. Instead, examine a variety of signals and data points to get a more complete and balanced view of what's happening. The more perspectives you have, the better your decisions will be. And remember, just because two things move together doesn't mean one causes the other. Crypto often has its own unique drama, with price swings that can defy logic and expectations. Economic indicators are valuable for providing context, but they don't guarantee outcomes. Use them to inform your strategy, not to predict the future with certainty. Stay humble, because no matter how much you know, the market has a way of humbling even the most experienced traders. Losses and surprises are part of the journey. Treat indicators as helpful tools in your toolkit, not as strict rules to follow blindly. Adapt, learn, and be flexible as new information comes in. Keep yourself informed, stay cautious, and always approach investments with a clear mind and a healthy dose of skepticism. The future of crypto is unpredictable and full of possibilities. So, be prepared for anything, stay curious, and never stop learning.